Okay. Now to start this topic, I would like you to introduce that there are two kinds of assets or two types of assets for income tax purposes. Number one is ordinary asset. When we say ordinary asset, that is an asset used in business. So the other type of assets for income tax purposes is what we call capital assets. So if the ordinary asset is used in business, so this one, these are not used in business. So we call them as capital assets. Okay, I have here a diagram in order for us to have the whole view. Not really the totally, but this is our direction of this discussion. Here we have the types of assets. Then after that, there is an ordinary and the capital assets. So basically, that is the criteria that differentiate the two ordinary assets and the capital assets. There are capital assets that are subject to regular income tax, just like with ordinary assets. By the way, for the ordinary assets, all of them are subject to regular income tax. In particular, there are two capital assets that are subject to capital gains tax. Capital gains tax are one of the final taxes, final withholding taxes, right? Meaning to say that every time that there is a sale for these properties, like for real properties and for the shares, the tax on that is withheld by the source or the one who will pay for the amount. Again, in particular, there are only two items under the capital assets that are subject to capital gains tax: the real properties that are located inside the Philippines and the shares of stocks that are issued by domestic corporation not listed. In other words, the transaction of the shares of stocks are directly to the buyer. It does not go through the PSE. For the again, these are the two, and each of these has its own percentage of capital gains tax. For the real properties, it's only 6%. For the shares of stocks, this is 15%. Now, if you can see, the percentage of the income tax, is substantially lower than the regular income tax, because if we're talking about individual, we have the highest of 35%, right? And for the corporation, we have 20 and 25%. Therefore, if you compare that with the 6% and 15%, they are substantially lower. So that's why it is always the intention of the taxpayer that before they are going to sell their stocks, their capital assets, they make sure that these are these are categorized or classified as capital assets subject to capital gains tax. But again, that is only limited to real properties located inside the Philippines. Capital asset, meaning to say they are not used in business. And also if these are shares of stocks, it must be issued by domestic corporations and they are not listed. Okay. So that is the again, that's the direction, because they have substantially low uh, percentage of capital gains tax compare if these items will be subject to regular income tax. Since we have already distinct or differentiated the ordinary by way of just using if this is used in business or not, there are circumstances that will lead us into confusion of classifying a particular asset that is a capital or an ordinary asset. But again, yeah. So because of some circumstances surrounding. Okay. Now we have number one. The number one is that the intention of having the property being purchased, if the intention of that is to be used in business, even though if that is for future, then that classification of that asset upon the purchase of that is an ordinary asset. So again, even if that is for future use in business, again, when you purchase that one, if you have the intention to use that in the future for business, then that is an ordinary asset. And for the depreciable assets, even though they are fully depreciated, their classification will stay at ordinary asset. Another thing is the effect of change in use. In general rule, even though if you change the use of that asset, you stop using that for as in business, so therefore it should stop to be classified as ordinary asset. But accordingly, it does not work like that. So it does not change its character. So it will stay at an ordinary asset. However, there's an exception for that. If if you have reported or show a proof to the BIR that you have not used or you did not use that asset for more than 2 years prior to the taxable transaction, ibig sabihin for if you are planning to sell that on December 1, make sure that before December 1, you have more than 2 years of that you did not use that in business, and you need to show a proof that you need to show a proof to BIR that that is the case, so that you can be the you are allowed to reclassify that asset to capital asset from ordinary. This is only applicable for those businesses other than those having real estate business. Ibig sabihin, hindi ito pwedeng gawin ng real estate business na taxpayer. Okay? Yung exception na yan. Now, in the case of the real estate business, if they stop having a real estate business and they change the nature of their business from real estate to non-real estate, so it could be merchandising, it could be hospital or service, other services, not a real estate business, it does not mean that the classification of those assets that you have been used in business while you were on the real estate business will change also its classification. So again, ang sabi ng batas, it will stay that way as an ordinary asset. Okay? So in other words, if you are a real estate business, there's no chance for you to reclassify your ordinary asset to capital asset, because even in the exception that is provided that if you're not using that for 2 years before the sale transaction of that real properties, if you're a real estate business, you are not qualified to use that one. Again, for real estate business taxpayers, there's no chance for them to reclassify their properties as ordinary assets to capital asset. The third is the real property rules. Number one is the real properties that are being used, or have been previously used, the trade or business of the taxpayer shall be considered ordinary business. So I think that's what we have discussed that earlier, that if that is used in business, that is an ordinary business. Now, that is an ordinary asset. Now, if there's an involuntary transfer, it's not your intention, but you are forced to do so, to stop using that because it was expropriated, foreclosed, etc. It doesn't mean that the classification will change also to capital asset. It will stay again as ordinary asset. It's not one of the exception. We have only one exception to that, as I discussed earlier. Number four is the special and transferred property. In case of real properties used by exempt corporation, those real properties are considered capital assets. The reason is that yung exempt corporations are not treated as businesses. So therefore, those assets that they are using are treated also as not used in business. Therefore, they are not ordinary. Therefore, those assets are capital assets. Now, the last one is if you receive a property by way of you purchase that property, you acquire it by exchange, inheritance. Your intention upon receiving that is the basis for the classification of that property, whether it would be ordinary or it would be a capital asset. Now, since the taxpayers engaged in real estate business is the only business or taxpayers that is not allowed or has no option or any chance to convert ordinary asset to capital asset, now it is very important for us to know who are those taxpayers that are engaged in real estate business. So we have identified three of them: the real estate dealer, second, the real estate developer, and the third is the real estate lessor. So we need to memorize this one because these are the three that are not qualified to convert ordinary assets to capital assets. And accordingly, if a taxpayer is a taxpayer considered as habitually engaged in real estate business, if it has 6 taxable real estate sales transactions in the preceding year. Okay, if it has 6 taxable, so they need to count up to 6. then it will be qualified. It is considered as a real or engaged in a real estate business. So therefore, it will be fall either of these three. We are going to discuss first those capital assets that are subject to regular income tax. We are not going to discuss here those ordinary assets because they are regularly discussed in some other topics as we study the tax rules for in computing the income or taxable income. So ordinarily or in regularly, what we are computing are ordinary or coming from the ordinary assets transactions. In here, we are focusing on the discussion of the capital assets, particularly those subject to those that subject to regular income tax and those that are subject to capital gains tax. So first, we are going to discuss those that are subject to regular income tax. Okay. Therefore, we are talking about those assets that are not real estate or that are not real properties located in the Philippines, and those that are not shares of stocks issued by domestic corporations and sold directly to the buyer. Okay. Number one important thing that we need to understand first is we need to know the definition of what is capital gain and what is capital loss. I think there's no need for us to think this deeply because it the capital gain follows what is the classification of that assets being sold. So if that is a capital asset, therefore, and it is resulted to gain, then we have a capital gain. If that is resulted to a loss, then we have a capital loss. Then other than that, we call them ordinary gain and ordinary loss. Now we have this what we call net capital gain. When I say net capital gain, if you have a lot or several transactions that are involving capital assets, and some are resulting to losses while others were resulting to gains, then you try to offset that if the gains are exceeding those losses. Therefore, we have the net capital gain. Otherwise, we have net capital loss. So those gains and losses that you are going to consider to include that one in determining whether there is a net capital gain or net capital loss are those gains and losses that were incurred